Welcome to Stress-Free Investing Analysis Personal Notes. If you've been following the financial news lately, you've probably heard the absolute panic surrounding India's largest decorative paint company, Asian Paints. The narrative is everywhere, right? Competitors are moving in, market shares supposedly just evaporating, and the stock has taken a pretty significant hit. But we have to ask ourselves, is this really an 80-year-old monopoly finally dying? Or is this just a classic case of a fantastic business transitioning to a new normal? Let's find out.
Okay, before we get too deep, please take a quick look at the SEBI compliance disclaimer up on your screen. Just to be absolutely clear up front, the analysis in this explainer is strictly for educational purposes and just represents my own personal research notes. Please always do your own due diligence.
All right, let's dive into this. Here is our roadmap for today's explainer. First, we'll look at the giant disrupted. Second, we'll analyze the financial trough. Third, we uncover the turning point. Fourth, valuation and targets. And finally, we'll wrap it all up with the final verdict.
Starting right off with Chapter 1, the 80-year giant disrupted.
Look, we really need to completely reframe this current market panic. Asian Paints is not some dying monopoly. It's simply shifting into a more competitive reality. Right now, the biggest fear driving the market is Birla Opus. Backed by the massive Adia Birla Group, they enter the space with a colossal 10,000 crore rupee war chest. That is an incredibly aggressive entry, no doubt about it. But here's the reality check we all need. Birla Opus currently has around 137 depots. Asian Paints, they have a mind-boggling distribution moat of over 70,000 dealers spread across 65,000 towns, built meticulously over 80 long years. You simply cannot replicate an 80-year network in 3 years, no matter how many thousands of crows you burn. It's just not going to happen overnight.
And honestly, you can see this reality perfectly reflected in the current market dynamics. Has Asian Paints lost ground? Yes. They've slipped from a 59% market share down to about 52% over the last couple of years, while Birla Opus has scooped up around 6.6%. And hey, that is a really impressive gain for a newcomer, absolutely. But let's zoom out for a second. Asian Paints still commands more than half of the entire Indian market. They are undeniably dominant. So the thesis here isn't that they are going to completely lose their crown. It's that they are going to stabilize as a highly exceptional business, holding on to a 50 to 55% market share.
Moving on to Chapter 2, analyzing the financial trough.
Let's step directly into the financial crime scene to see if the underlying business is actually broken. Negative 33%. Ouch. That was the dramatic drop in profit after tax for FY25, marking one of the worst declines in their recent history. And paired with that was a totally terrifying negative 374% return on incremental invested capital. Sounds awful, right? But let's translate that into plain English. Basically, Asian Paints spent huge amounts of capital building new factories, over 11,000 crores in recent years, at the exact moment when their profits took a temporary dip due to market pressures. Deeply negative incremental returns look terrifying on a spreadsheet, for sure, but this is a cyclical timing issue. It is not a permanent structural failure of the business.
Now, what's really interesting here is the massive recovery signal that the broader market is just seemingly ignoring. From a painful trough of 15.5% in Q4 of FY25, their EBITDA margin has steadily climbed, literally hitting a record 20.1% in Q3 of FY26. How? It's being driven by raw material cost deflation and some incredibly strict price discipline by the management team. The bleeding hasn't just stopped, folks. The profitability engine is roaring right back to life.
Which brings us to Chapter 3, the turning point.
Okay, this is where we uncover the most underappreciated bull case for this company. This is our big aha moment. Take a look at this capital expenditure normalization. Back in FY24, they were dumping nearly 4,000 crores into heavy factory building. But by FY26, that heavy lifting is done, and spending is estimated to plummet to roughly 600 crores. Because their massive investments in fixed assets are effectively dropping to near zero, almost all of their future earnings are going to convert straight into a massive free cash flow explosion. Even if their actual profits stay completely flat, their free cash flow is set to nearly double.
And let's not forget, the foundational financial health of this company remains ironclad. They're sitting on roughly 2,800 crores in net cash, they're generating over 5,000 crores in cash flow from operations, and their accounting is totally spotless with a clean Benish M score, meaning absolutely zero signs of financial manipulation. But perhaps the most telling signal, domestic institutional investors, the smart money, have actually increased their stake from 18.5% up to nearly 22%. They have been quietly buying the dip on every single decline, showing massive institutional conviction in this recovery story.
So let's talk numbers in Chapter 4, valuation and base targets. We know the business is healthy and recovering, but that leads us straight to our core problem today, valuation. 69 times. That is the trailing 12-month price-to-earnings ratio. Guys, this multiple is just far too rich for the current reality. A 69x PE ratio implies you are pricing in an extraordinary, totally unchallenged monopoly. It absolutely does not price in a 52% market share player fighting off well-funded conglomerates in an ongoing price war.
When we actually run the scenario analysis, the picture becomes glaringly obvious. At the current market price of around 2,600 rupees, our base target of 2,800 only offers an 8% upside over the next 18 to 24 months. Meanwhile, if things go south, the downside risk to our bear target is a painful negative 27%. Simply put, at 2,600 rupees, there is just not enough margin of safety to justify taking on those competitive risks. You are effectively paying for perfection in a market scenario that is very far from perfect.
All right, bringing it all together now in Chapter 5, the final verdict.
We've seen the disruption, we've seen the upcoming cash flow explosion, and we've faced the harsh reality of the valuation. Here is our final scorecard. Asian Paints earns a stress-free score of 70 out of 100, which lands at a solid grade B. It scores incredibly high on its moat and financial health, but it gets penalized heavily on that sky-high valuation. So the final verdict? Asian Paints is absolutely the right company, but right now it is trading at the wrong price. Our official stance is a hold, and we recommend accumulating only when the price drops into the 2,100 to 2,400 rupee zone.
So here is your exact stress-free execution strategy. Step 1. Exercise a little patience and wait for that 2,100 to 2,400 rupee buy zone. Step 2. Just set a good till canceled order in your brokerage account. That way you don't have to agonize over watching the screens every single day. And step 3, circle May 29, 2026 on your calendar right now. That massive board meeting is going to reveal Q4 results and, much more importantly, their FY27 guidance. If those results happen to disappoint the broader market, the stock will likely dip right into our buy zone, handing you the perfect entry point.
But hey, to keep your investing truly safe, we always have to watch for the thesis breakers. What could go wrong? Well, if you see Asian Paint's market share actually drop below 48%, or if their EBITDA margin gets stuck below 15% for 2 consecutive quarters, or if their long-term debt doesn't start normalizing down from that 3,000 crore level, then this whole recovery narrative breaks and you'd need to reevaluate your position immediately. So the ultimate question you have to ask yourself today is this. Do you have the discipline to wait for this 80-year giant to hit the perfect price, or will the fear of missing out force your hand?
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.